Greetings. Today is Friday, August 2nd, 2024, and this is our monthly market monologue where we will review the stock market and bond markets for the month of July. We'll talk a little bit about what we're seeing so far in the month of August as well as the seasonality trends. But before I dive in, I would love it if you would leave me a comment at the end of the video. Tell me what you think, especially of the new background. Over the last week, we have moved into our new office just about 2 or 3 miles from the old location. So we're all, for the most part, settled in, but obviously the background has changed. I would love your feedback. What do you think? That said, I would also be remiss if I didn't encourage you to make sure you hit the like button and subscribe to the YouTube channel if you have not already. We certainly appreciate that. All that helps the algorithms. And by all means, feel free to share the videos with your friends, family, colleagues, etc. For those of you that are not familiar with Hicks Associates Wealth Management, we serve individuals and families by serving as their chief investment officer, proactively managing their portfolio in a fee-based fiduciary capacity. Our active management approach is designed to minimize drawdowns while capturing upside momentum. If you'd like to learn more, just navigate to hicks-associates.com and you can learn more. If you want to chat with us, just hit one of those big blue buttons. That said, let's dive in. So let's start off by taking a look at the month of July in review. First up is the S&P 500 as measured by SPY, the S&P 500 ETF. That was up about 1% in the month of July. Take a look at RSP. We've talked ad nauseum on this channel about the difference between the traditional cap-weighted measure, which is SPY, versus the equal weighted version, which is RSP. So RSP gives equal billing to every stock in that index versus SPY is going to overweight the biggest boys in that index. So RSP was up 5.31, quite the divergence. We'll talk more about that in just a minute. We also want to show you what happened with the NASDAQ. The NASDAQ was actually negative 1.5, almost 1.6 for the month of July. So pretty volatile month there. And then take a look at the Magnificent Seven. That's the blue line there at the bottom. The Magnificent Seven was actually negative almost 3.7% for the month of July. That is very important. And then we will also take a look, we'll add in mid-caps. Mid-caps is that gray line up about 4.85%. You can see that right here. And then we will add in small caps. Take a look at the small cap sector. Small caps posting an 11% rally in the month of July alone. So that's quite the divergence between the large cap and the small cap. And we've been talking about divergence for quite some time. However, the story has been that the Magnificent Seven have been leading the market and everybody else, mainly the small cap in particular, have been lagging behind. So we've been talking fairly consistently about the importance of the small cap stocks or smaller companies. That's what that really means. The smaller company stocks have really got to start participating in order for us to really have a ton of confidence in this bull market. Well, small caps finally showed up in a very big way. Now, they've done well recently, but last month was spectacular. So that is an important development, and we'll come back to that in a couple of minutes. But what's also very important is to notice how much drag the Magnificent Seven have had on the S&P 500 for the month of July. We'll probably touch on that as well. So let's come back here and we'll add in the iShares US Treasury bond. The 20-year bond is right here. This green line, 20-year treasuries were up about 5.5% in the month of July. A fantastic month for treasuries, especially important for these traditionally conservative investors. And then we'll add in the iShares Aggregate Bond Index, which is AGG, also positive 3%. So overall, a pretty good month in the month of July. And now let's take a look at each of the individual candles quickly, and we'll talk about what do we see for the months of August and September. And so on the screen, we have the S&P 500. This is, again, is the traditional cap-weighted index. Again, those Magnificent Seven stocks, the biggest stocks in that index, are going to have an outsized influence on how the S&P 500 does. So that is the traditional cap-weighted index. Let's flip to the equal-weighted index, and you can see a little bit of a different story. If we flip back to the S&P 500, the traditional measure, you can see a little bit of a sell-off, because remember, the top of a white candle the body of the candle, not this wick is called a wick or a shadow sometimes. The top is where the market ended. So if you look at the equal weight version, we had a much stronger close on RSP, the equal weight version. Now let's put those two side by side and you can maybe see what I'm talking about. You see the equal weighted version has a much better, stronger close than the traditional cap weighted S&P 500. That is important because while there's a little bit of a sell-off in the NASDAQ and the Magnificent 7 stocks, the rest of the market is starting to come alive. Speaking of the NASDAQ, here we have the NASDAQ again. It's got a black candle with a very tall wick on both ends. So upper and lower shadows is what they're technically called. But the candle itself is black. So actually what that means is the NASDAQ was negative for the month of July. But what I really want to highlight is the height of that entire shadow from top to bottom. So pretty volatile month for NASDAQ. And what we are seeing is a rotation out of the technology sector. Technology has been leading, but so far that appears to have changed. Now we're going to spend some time talking about the Russell 3000. If you've been watching our videos for any length of time, you know that this is one of the ways that we really measure the health of the overall market. We have lots of ways that we do that, but we really like to look at the Russell 3000 because obviously it's a much broader measure. It's not 500, it's 3,000 stocks. And so it's capturing both the large cap, the big boys, as well as the small caps, the little guys. It's capturing all of that in this particular ETF. Now it's still cap weighted, so we still have that challenge, but in particular, we'll look at the breadth measures in just a second. But here again, you can see a little bit of a sell-off in the Russell 3000, but overall a decent close for this broader measure. Now, if we switch to a daily candle chart. Now on the top pane we have again the Russell 3000, but every candle is a day in time. So this is the Russell 3000. You can see it bled off a little bit. It rallied towards the end, had a bad close on Thursday, but I want to spend time looking at this advanced decline line down here at the bottom. Remember, the advanced decline line is taking the advancing stocks, you simply subtract the declining stocks, and that's how the advanced decline line is drawn. And if you recall from some of our prior videos, we were concerned that we have a negative trend here. We had the Russell 3000 going sideways and then up while we had the advanced decline line going down. That is a negative divergence. That is very discouraging because it's telling us that those biggest stocks are advancing, but there's more stocks that are falling than are. That's a bad sign. That's a warning sign. And this falls under the, and you'll hear me say this probably again, this is not a signal, this is a sign. It's a warning sign. It's kind of like when you drive into Virginia. If you're in North Carolina, you drive into Virginia and you see the signs that says speed is monitored by aircraft. That's not a signal that there's a plane above you. That is a sign, that is a warning sign that there might be a plane or a helicopter or something like that above you monitoring your speed in addition to the other speed traps. It's not a signal, it is a sign. It's a warning sign. That's what this is. But look in particular at where the advanced decline line ended for the month of July, at all-time highs. And so at the top here we see the price has come in and it has come back up a little bit, but we are not at a high. We have not taken out this high here. But what happened to the advanced decline line? It also came down, but it closed the month at an all-time high. That is a very, very encouraging sign. But I also know how the next day went. So we'll come back to that in just a second. Next up, we're going to talk a little bit about seasonality. This is our seasonality chart where we are looking specifically at the S&P 500. What's the average monthly performance for this index from 1950 through the current year? And inside the month of July's bar, you can see that blue dot. If not, it's right next to my red dot. That's 2024. So the month of July was ended up being just about as strong as the typical average monthly candle is in the month of July. So a very strong month. However, look at August. Historically, August is a fairly flat month in the S&P 500. And September is a pretty negative month. Likewise, when we look at the seasonality chart for the S&P 600, which is the smaller cap stocks. Now remember, this only goes back to 1995, simply because small cap stocks didn't exist. We didn't have it classified that way up until about 1995. But again, look at that blue dot. That blue dot is 2024 versus the average month of July. So small cap stocks showed up in a very big fashion, but again, look at August and September. Not encouraging signs for the coming months. Let's return to this chart of the advanced decline line for the Russell 3000. I indicated that this is a very encouraging sign. Arguably, it's a little bit of a bullish divergence. This was a bit of a bearish divergence here where we have declining advanced decline line. But now we have rising advanced decline line while the price has not yet reached a new high. This is not necessarily a traditionally bullish divergence, but it's still a very encouraging sign. However, with most of my monthly market monologues, the charts that I'm trying to show you are trying to capture the month end. But as I'm capturing the slides yesterday, the market was selling off pretty hard. So let's take a look at an update. Now I am switching. This is now the Russell small cap. This is the Russell 2000. But this is really, the point is still the same, because that's the candle from yesterday. A pretty ugly day in the overall stock market yesterday. Today does not look all that much better at the moment. It's still early in the day, but still fairly discouraging. As I said earlier, when we talk about these things, these are signs, they're not necessarily signals. So while it is encouraging that the advanced decline line closed the month at an all-time high, that doesn't mean it's guaranteed to move higher. It is just a data point that we have to consider. There's no such thing as a technical indicator that has 100% accuracy as far as the stock market. We can certainly talk about economic data points that have a perfect batting average, and we've talked about that in our most recent videos with the yield curve and the Schnepp recession indicator. We'll come back to that at some other video. But when we look at the small cap space, the Russell 2000 IWM, we've been talking about this big blue-gray area as a 2-year trading range. And we were struggling to get, their small caps were struggling to get out of this trading range. And in March, we escaped, but didn't have quite enough escape velocity, fell back in it. Well, we came out of that again. And so this correction, while ugly, is not necessarily a nail in the coffin or anything like that. It is very, very common, and you saw it right here. It is very, very common for a stock or a sector or an ETF or whatever. It's very common for, after it pushes higher, to go back and test. So this area was a prior level of resistance. Classical technical analysis says that prior resistance becomes support. So it won't be surprising if this Russell 2000 comes back in and tests this level right in here. And if we look at that red line is the 50-day moving average. And so while we would like to avoid having these retests, they're not very fun, because we got stopped out of a couple positions in yesterday's trading activity and got stopped out another one earlier this morning. But it is not surprising to see small cap coming back in, and it won't be surprising. I don't know if this is definitely going to happen, but it won't be surprising if small cap comes right back into this range right here, because that's also the 50-day moving average. So that is the next thing that we're really going to be watching, is to see if that 50-day average and this price level acts as support, where we can bounce the market, or at least the small caps can bounce off of that. And so that's where we're at right now. Now, from an economic standpoint, I don't know if I'm going to shoot an economic specific video this particular month, but from an economic standpoint, there's definitely data that suggests the economy is not as strong as some people believe that it is. And so I will throw this chart back up on the screen. This is my favorite chart that shows the S&P 500 from 1965 through 1979. And as my point here is, I'm not suggesting that this is going to return, but I'm just trying to show actual U.S. stock market history of a secular bear market. Secular means long term, that experiences cyclical bull phases. So within this 15-year time period, which many would define as a secular bear, there was periods like right in here or right in here. These are cyclical bull phases. Cyclical is short term. These are cyclical bull phases within the confines of a secular bear market. So far, my thesis that we could be in a secular bear market that is experiencing a cyclical bull phase, that is still intact. So that is not, I'm not trying to be prophetic. I'm not trying to predict that that's going to happen. But as encouraged as I am with some of the underlying stock market data, I also look at the economic data to shape what we call our macro view. And we definitely have concerns about the road ahead. We have massive levels of debt as a simple example. And so at some point, we should not be surprised as a nation. We should not be surprised if we have a debt crisis because our debt has gotten out of control. So that is certainly a possibility that those types of economic calamities could exacerbate a stock market correction, so that we could very well be in a secular bear that is merely experiencing a cyclical bull. And when we have a cyclical bear within a secular bear, the question is, are you prepared? We are prepared. If we're managing your money, we have a plan for that. We have a plan for if we're wrong. We have a plan for if we're right. That is how we manage portfolios for clients. We're not predicting. We don't make predictions. We're not making prognostications. We are simply trying to communicate to all of our clients that we are prepared. No matter what the market is going to throw at us, we are prepared. So if you have any questions, by all means, feel free to reach out to us. Whether you're a client of ours or you're not a client of ours, feel free to reach out. We're happy to take questions. And again, do me a favor and leave me a comment below. Let me know, what do you think of the new background? Hopefully you can't hear the buzzing fluorescent light that's above me. I have tried to dampen the gain on the microphone, but the lights are on the list of things to change. So, but I would love your feedback. What do you think of the new background in the new office? If you're here locally, feel free to stop by and see us. Until next time, thanks for watching. Hope you find this helpful, and we'll talk to you soon.